I'm
Yes,
waiting.
sir, we
Yes,
can
sir, we
continue.
can move on.
All right, thank you. So yesterday we spoke about exempt income. So guys, I've corrected the learning outcomes slide. Remember yesterday I had the wrong slide here for the learning outcomes. So let's just go through it again. We will identify amounts that are exempted from the income tax that we will find in section 10 of the Income Tax Act of South Africa. We will apply the criteria to determine the applicable exemptions, and then we need to be able to demonstrate an understanding of the work by calculating a taxpayer's income. And we know, how do we calculate a taxpayer's income? That is gross income minus exemptions or exempt income, and that will give you the income. So first the theory, and then we should be able to calculate the income of a person. Yesterday we said that amount should first be included in gross income before it can be exempted, and then it will obviously be exempted. So yesterday we've dealt with this already. We said if you are exempted, it means you don't have to do something, or you are not affected by it, and exempt income is therefore not subject to normal tax. In my normal tax framework, guys, I'm just doing a recap because we've done this yesterday already. I want to get through the work that we have to cover today. We are busy with exempt income. If you look at my little arrows, so the red part there, we are busy. And by the end of this semester, we should be done with each of these. And we've now seen that it's not as simple as just saying gross income. There's actually a lot of things that you need to consider, including special inclusions. And now we look at exempt income, and that will give us income. Later we'll look at deductions and allowances. We will look at other inclusions such as capital gains tax. So this is a positive one, an add. That will give us taxable income, and obviously we will use the table to calculate the tax liability of person. Then, so guys, we said exemptions for tax 202 is found in section 10, 10A and 10B of the Income Tax Act, and exemptions only apply in respect of normal tax. Yesterday, I also gave you the two types of exempt income, or reasons why income will be exempted. We said firstly because the entity might be an exempt entity. Today we will look at those type of entities like municipalities, political parties. Those are all entities that is exempted. You know, in Namibia we have SWAPO, PDM, LPM, all these. Those are all entities that is exempted for tax purposes. And then secondly, because the income that certain people or entities earn will be or qualifies as exempt income. So exemption because it is a special type of income. Now guys, there is some self-study areas in your prescribed textbook. Remember, the assumption is that you do have the textbook, and that you can find in paragraph 4.2 and 4.3, which is government and related organizations, guys, municipalities. You know, in Windhoek, if we look at city of city police, those type of government-related entities are exempted. Even the government, you know, the government as a whole, they are exempted from tax because it doesn't make sense that they also have to pay tax. Now, guys, don't get this wrong. The employees working for the government pay tax. I'm talking about the government as a business, because in essence, you know, the government is not in all aspects a business as you would call a normal business. Really, guys, this is simple. If you have to put the government next to Standard Bank, you will tell me that the one is a business and the other one is actually not. And I put it in inverted commas, not a business. Government, service to the people. That is why we vote for the government and all these things. While a business, you know, you can decide how to run it. So paragraph 4.2 and 4.3 deals with funds, certain funds like GIPF. Guys, I'm giving you Namibian examples, but remember we are busy with South African tax but I'm just giving you, because that would make you relate a little bit easier. Social Security Fund in Namibia. In South Africa, they also have these things. They have different names. Obviously, I'm not going to test you specifically on that, but what you need to know is you need to go and read paragraph 4.3 so that you can look at funds and clubs. Sorry, and once again, I just need to reiterate that clubs is not nightclubs. A nightclub can be a business. When we talk about clubs, we talk about social clubs, we talk about recreational clubs, we talk about tennis clubs and, you know, sports clubs and all these things, even movements. Here with government and related, I even want to add a movement such as the what is the movement for Job Amupanda AR? Yeah? These are all exempt entities because they are, in essence, actually business, but they are exempted from paying any taxes. Now let's look at certain special type of income, and that you will find in paragraph 4.3, such as funds and institutions and clubs. Now guys, I already mentioned a few just now, GIPF, the various clubs. Then certain pensions are also exempted. For example, let me tell you one, the old age grant that our people get on a monthly basis, the elderly who is 60 years and older, that pension is exempted because it is a special type of income. However, guys, don't get this wrong. If you get a pension because of where you worked, let's say you worked at Old Mutual, now you retire and now you get a pension, that one will not be exempted, or maybe a portion of it will be exempted. That is why I'm saying certain and not all. Only certain pensions will be exempted. Then UIF benefits, yes, that is the name they use in South Africa for Social Security. Unemployment funds, so basically when COVID hit last year, a lot of people got payouts from the UIF. So, and then interest will also be exempted. Guys, interest will be exempted from tax, however, or from normal tax. However, there is withholding tax on interest. So there's another type of tax on this. Dividends, we know dividends should be included. It's a special inclusion. Now you can see the full dividend will be, especially if it's a local, and I just need to reiterate that this is local, then we say it will be fully exempted. Why? Because there's actually another type of tax called dividends tax, and currently the rate is 20%. Guys, foreign dividends, there's also a portion that will be exempted. However, it's not the full amount. We will look at that calculation a little later. Then royalties. Now, you know what is a royalty? My intellectual property, like textbooks that you guys so often steal and use without permission. You are actually stealing people's royalties because someone wrote that book, and that person needs to be compensated for the intellectual capacity, for their wit and labor. What if they use their time, they use their energy, so their wit, they need to be compensated for that. But including gross income and then exempt again. Reason for that, there's another type of tax called withholding tax, and that one is the tax that, so you see guys, yes, it might be exempted from our, from our normal tax, but there might be other types of taxes. Therefore, it doesn't make sense that it's taxed here and there again, because then it will be double taxation. And remember, the government want to tax you as little as possible. Then alimony and maintenance, that's also a special type of income. We have talked a lot about alimony and maintenance. If you are divorced, your ex-partner or ex-spouse might have to pay you alimony, a monthly allowance, or even maintenance for kids. That is a special type of income that will also be exempted. Then rebates, subsidies, and grants. Now, guys, best example I can give you again, last year with COVID, our government gave most people 750 Namibian dollars. In South Africa, people got 350 rands, but they got it for a very long time. I think they still get it, or did it end? But it's more than a year that they got that 350 per month. That's a type of grant. It was also exempted from tax. Then subsidies in Namibia, when we have droughts, when there's drought in Namibia, then our government through AgriBank sometimes provide these subsidies to our farmers. In South Africa, it's also a big thing where people get subsidies from the government. It's basically government subsidies that will also be exempted. The full amount will be exempted. And then certain rebates. Now, the one rebate that we will be talking about is for a natural person. If you open that tax table that I've attached on the test, the last page, if you look at that, we will, in our next test, I will include the rebates as well, because you will see that people who is under 65 years, they have a rebate of 14,000, and that is more relief. So basically, if you get a rebate, then it will also, certain rebates will also be exempted. And then obviously annuities, but we know it's not the full annuity. We already know Y equals to A over B times C. So we have to calculate the capital portion. Then we will also look at war pension and awards for diseases and injuries. Now, guys, remember we spoke about this under special inclusion already. If you receive a war pension, obviously you need to include it in gross income. And today we will see that the full amount will be deducted. So our war veterans in Namibia, just like in South Africa, they are also war veterans. If they get a war pension or war payout or veteran payment, because in Namibia, war veterans get a monthly salary on, it's not salary, payout on top of their pension grant. They get that as well, because we know that these people have fought for the country and they have liberated us, so they get those war pension and it's non-taxable. So you cannot, someone that is a veteran, someone that is a hero, we don't tax them. So full amount in terms of Section 21G, full amount for war pension. And then even, guys, compensation in respect of diseases from mining. Sometimes when you work in the mine, guys, I know of someone, a friend who worked. Guys, can you guys still hear me?
Yes, nice.
All right, thank you. Sorry, I saw my thing, my computer was just loading here, so I thought I might have missed you. Oh, yes, I know a friend of a friend who worked in the mine just here in Swakopmund, outside Swakopmund, and that person contracted a disease, you know, because of the material that they worked with in the mine. So mine jobs are also very, very risky, because first of all, the mine you can actually get, you know, I don't know, you can actually get killed inside the mine. If you watch those, what is those nice soapies? Just last week I saw there were some people in the Queen or wherever, people actually inside the mine and they couldn't get out. I'm sure some of you watched that. It's very difficult, guys. I'm telling you, it's already difficult if you just get stuck in an elevator. Imagine getting stuck in a mine and you don't know if you'll get out alive. So if you get any compensation in respect of diseases that you contract from mining, that will also be exempted. That will be exempted. Then Section 101G Cap A, here we look at disability pension. So guys, if you get a disability pension, it will be, let's say I work at NUST and then I get a disability while working there. Let's say there's an accident and now I'm staying at home. Remember, I'll get a pension because I am currently insured. then that pension that I'll get, that will be exempted for tax purposes. Okay, but first I have to include it in gross income. Section 10(1) Cap B, compensations received in terms of Workmen's Compensation Act. So guys, in Namibia, we call it Social Security. So if the ladies fall pregnant, then we know they go away from work for 3 months. And guys, and then Social Security actually pay them an amount. Now, guys, currently in Namibia, there's a lot of debate about Social Security because it seems like Social Security somehow they are discriminating against professionals. Who is professional? Professionals is accountants, lawyers, and all of these people that studied. The reason why I'm saying this is because the maximum amount that Social Security pay anyone is 13,500 per month, and that means you should even be at a very high salary scale for you to earn that. Now, guys, that is very discriminatory, especially even if you are an accountant. Let's say you earn $20,000 at your workplace, and now all of a sudden, because your work will not pay you during those 3 months, you get a payment from Social Security or Workmen's Compensation. So they only pay 13,500. Guys, I'm telling you, if you are used to your 20,000 Namibian dollars and now you have to get 13,000, it's difficult. It's very difficult. So we said that let these people then contribute more monthly, but let them also get more, because it also look like it will discourage women to fall pregnant, because you're actually worse off then. Obviously, I know you need to plan and all these things, but why should I? If I'm a professional and I contribute to Social Security, why should I also now plan out of my own pocket? Because I've actually made provision for that. So how will the population grow? And you know, the one problem is always leading to the next. Then compensation for occupational injuries, that is actually the one that I told you. Let's say I fall at work at NUST, and now I need to get a monthly salary. That is also, and I can't work anymore. Let's say maybe I lost my finger or whatever, and I can't work, then that's an occupational, because I got an injury while I was at my job, at my occupation. And then the Disease Act or Road Accident Fund Act, guys. Remember that some people, I'm sure you guys know, some people that have been in an accident on the road, and then MVA pay them out. That money that they get from MVA is also exempted. However, guys, there is a limit of 300,000 in South Africa. In Namibia, there is no limit. So even 1 million that you get, it will be tax-free. In South Africa, there's a limit of 300,000 rand, so 300K. Then foreign pensions, in terms of Section 10(1) Cap G, small g, Cap C. Here we look at foreign pensions. Now, guys, you need to be a resident of South Africa. The pension should relate to past employment, and it should not be from a South African insurance company. Insurance company being Old Mutual, Sanlam. These are just some of them. There are so many in South Africa. And then we also need to calculate and look at what is the lump sum. Now, guys, let me put this into a practical example, all right, before we actually look at an example. Guys, it can be, let me give you an example. It can be that even you, who is a second-year student, you graduate next year, and then you go work immediately, let's say 1 year at an audit firm, and then you go abroad for 5 years, go live there, work there, and your pension, let's say that 1 year when you were working here, you paid pension, you contributed to a pension fund. Then the 5 years that you are abroad, you also contribute to the pension, and let's say you don't eat the money, you just keep it in that pension fund. 5 years abroad, get pension again there at your foreign company. Then you come back to Namibia again because you were kicked out because you can't submit a test online. No, you were incompetent. They kick you out, so you come back to Namibia, work here again for 5 years, paying again towards that pension fund, and then you retire. Let's say now you are 60 years old, you retire. Now guys, there's a whole calculation that we need to do, because the foreign pension, the 5 years that you were abroad, that will not be taxable. And then even here with the part that actually relate to South Africa, let's say Namibia, because we have the same rule, guys. We have the same rule here. So the 1 year before you left for the 5 years abroad, and the 5 years when you came back, that is 6 in total. Only those 6 years with pension must be included in gross income, and then we will obviously look, is it more than 300,000? If it's more than 300,000, then you can only exempt the 300,000, the rest cannot be exempted. But what am I trying to tell you? You take out the foreign pension because it doesn't relate to a South African source in that case, or let's say you were not a resident during that time. Obviously, if you are still a resident in terms of the physical presence test, then obviously you will have to include the worldwide income. Let's look at this example. Mr. Gold is a retired miner. 2 pensions accrue to him during the year of assessment. Firstly, a pension of 8,000 Rand a month for past services rendered, and secondly, a pension of 1,500 a month for having contracted that disease, a disease often contracted by persons employed in mining operations. Guys, it's a type of yellow fever. I actually researched this a little while ago. So they say, sorry, a type of lung disease because of maybe all the toxic gases and things that you inhale. So some people actually contract. Apparently, it's very common in mine workers that they contract this. So guys, it's a very risky job. Yes, mines pay a lot of money, but in terms of security, job security, you never know when there will not be a mine anymore. And secondly, you can contract a lot of diseases. Say, which of the above amounts would be exempt from taxation? Obviously, the 8,000, we will not have, we cannot exempt that one since it was for services rendered. Full amount will be taxable. No exemption is available. However, the one for the pension for contracting the disease, yes, you include it in gross income, but you exempt the full amount in terms of section 101G, in terms of section 101G, any amount received in terms of compensation in respect of diseases from mining. Now, guys, be very careful in a test when you tell me section 101G, section 101G cap A. Rather just say section 10, then you are safe. Because if you say section 101GA for war pension, I am supposed to mark you wrong because section 101G cap A deals with disability pension and not with compensation for diseases. So be very careful. And rather, I always advise students to just say in terms of section 10. Let's look at section 101M cap B, UIF benefits. So let's look at UIF benefits, and what do we say about UIF benefits? So any benefit or allowance payable in terms of the UIF Act is actually exempted. Yeah? So UIF, I just quickly want to check something here on my side. So in terms of any UIF Act, where we say if you get an amount in terms of the UIF Act, that amount will be exempted. And UIF just stands for Unemployment Insurance Fund. Like I said, guys, in Namibia, we call it Social Security. The UIF provides short-term relief to workers subject to certain conditions when they become unemployed. Now, guys, sometimes the Social Security or UIF will even pay you for 3 months a salary when you get retrenched. they will give you a salary for 3 months, and that money will be exempted. Obviously, first need to be included in gross income, or unable to work because of illnesses, maternity, or adoption. Guys, in South Africa, even when you guys adopt a child, and you need to be away, but remember, it's a lot of court situations that you have to attend and all of this, you can actually claim from UIF and that money that you will receive. Yes, is there a question?
Yes, I have a question.
Yes, please go ahead, ma'am.
I would like to know if you have any work problem and you're still able to work, but you receive an income from this problem, you still have to include it or you just exempt?
All right, can you just repeat? So what I got from your question is, let's say you got can you just repeat the question? Sorry.
You had a problem
What
relating
problem
to
is
work.
this? What problem is this?
You hurt yourself at work or something like that.
Okay, injury, yes, go ahead.
Yes, and you are able to work, but you receive income from this injury that you had. Do you still include this or exempt?
All right, thank you. It's a good question, Talma. So what she's asking is, let's say you got injured at work and now you stay at work, at home, getting your pension for that injury. However, you are not that hurt and you actually start working again, yeah? And now you get an income for the work that you do. So Talma, what we can see here, it's two different things. The one is your pension that you got, or your payout, sorry, let me say, your payout out for the injury. Now, obviously, that one will be exempted. But if you work again and you get a salary or any amount, that will not be exempted. Did you get that, Thelma?
Yes, sir. Thank you.
All right. So only the portion that relate to that injury or that, that pension or that payout that you got for that injury, that one will be exempted. And remember, there's even a limitation of 300,000. Now, we spoke about the 300,000. But if you now work again and you get money, that will not be exempted. I know you probably look at it from a humility point of view, where you say, but this person is already hurt, and maybe they really find it difficult. That is why he also found another job, a second job, even though he gets that pension. So then it seems like that person should not pay tax because they find, it's difficult, it's hard for them at home, and because of this accident. But remember, we should always remove our emotions and just apply the act, and the act is that only that part that related to the injury or whatever you want to call it, that will be exempted. Any other income included in gross income, no exemption. All right. Then the UIF is financed through monthly contributions by employers and employees. So guys, in Namibia, currently I'm paying 81 Namibian dollars a month, and my employer NUST pay 81 Namibian dollars. So we contribute 162 per month towards Social Security. Now guys, the flip side of this is some of us never get injured in our life. And like, if you take me, for instance, I am now working for 12 years. I've been contributing for 12 years, $81, and my employer also 81 to the Social Security Commission of Namibia. And that is probably money that I will never see because I can't give birth. Like a female that will maybe benefit. For me, the only benefit for at Social Security is if I now get retrenched, or if I now get injured, or if I get retired. I've seen it. If you retire, they pay you $8,000 for all the years. Now, guys, all the years that you contributed $81, that is not $8,000. It might be more. They only give you $8,000. And if you die, I think if you die, they also pay something up. But I'm trying to tell you that I've been contributing for almost 12 years and I did not actually benefit anything yet. And that is because I contribute and your employer. Guys, in Namibia, it is compulsory for employers to register you immediately when you start working. They need to immediately register you for Social Security, and you will get a Social Security card so that if you get injured at the workplace or anything, then you will get your payouts. But like I said, the maximum amount that the Social Security currently pay in Namibia is 13,500. Imagine, guys, that is very, very, to me, it is not forward-looking. Imagine if you take a CEO of the Namibian banks. Remember, three of the banks in Namibia have female CEOs, you know. Let's say, who are all chartered accountants. Let's say they, fall pregnant and they need to, raise a baby. Obviously, they will be at home for 3 months. Imagine a CEO. What does a CEO earn? A female CEO. What does that person earn? Imagine now you have to earn 13,500 Namibian dollars for 3 months. It's not worth it. It discourages females from falling pregnant. I'm sure some of you will disagree with this. This is my opinion and I stand by it. Section 10(1)(h). South African source interest received by non-residents. So section 10(1)(h). Oh, there's a question. Let me listen to you. Yes.
Say now about the women who get pregnant. Do they have limitation like
oh, do they have a limitation on the number of babies? Is that what you're asking?
I know, like, say, no, I mean, like, is it normal for them to give a maternity leave to, let me say, like, one lady or a woman every year she's getting pregnant?
Okay, that's a good question. There's no limitation. I think those are probably some of the things that Social Security took into account, saying that in some cases we are losing and in some cases we are winning. We need to balance this. So his question is, what if a lady falls pregnant every year for 10 years? There's no limitation. That person will get that 13,500 every year. When they fall pregnant, they will get it. So there's no limitation there, okay? As long as you are a paid up contributor to the Social Security. Now, don't now get 10 babies because of 13,500. Babies are expensive, guys. Also, some of them are evil. All right, let's continue. Naughty. When I say evil, I mean naughty. They are naughty. It's naughty. Kids are naughty. Exemption for interest received or accrued by any non-resident unless that natural person is physically present for more than 183 days, or the debt is connected to a permanent establishment. PE is not Port Elizabeth, it's permanent establishment in South Africa. So guys, South African interest received by a non-resident. Let's put this in a scenario. So you are a non-resident in South Africa. Let's say you are from Spain, or let's say you are Cristiano Ronaldo, who's now in England, and now you're in South Africa living there, but you are still a Portuguese person or nationality, whatever you want to call it, but you get South African interest. And we say the full amount of interest will be exempted provided that this is met. If you were physically present in South Africa for more than 183 days in that year of assessment, or the money that you received, so the principal amount is connected to a permanent establishment in South Africa. So permanent establishment, your business dealings, and you guys can go read up on what is permanent establishment. So if it's connected to, maybe you have a branch. Yes, your business is not registered in South Africa, but you have a branch in South Africa. So it can also come down to having a permanent establishment there. But guys, once again, yes, the full amount will be exempted. However, there is 15% withholding tax that you need to pay. Now, let's look at section 10.1, interest for natural persons who are residents. So guys, this was interest for non-residents. Now we look at interest for residents. 10.1I, only applicable to natural persons. Remember, natural persons are people that can feel, that can love, you and me, people that hurt each other's feelings when they don't submit their test online. That is a natural person. That is someone who can feel. That can feel. All right. The amount exempt for interest will depend on the person's age. So very important, guys. If the individual is younger than, so less than 65 years old, then you have a limit of 23,800. If the individual is 65 years or older, that person have a limit of 34,500. Guys, let's quickly do an example because a lot of people get this wrong. In the test, I tell you, Mr. X got 50,000 interest. He's a resident. Guys, and he is 19 years old. Then he obviously falls in this category. He's less than 65. Guys, what that means is you now have to say 50,000, but 23,800 will be exempted. Therefore, the rest, the difference between these two, the 26,200, I think, if I'm not mistaken, that will be taxable. This will still be taxable. Let's put it in another example. Let's say Mr. X, the same guy, 19 years old, got interest of 23,000 Rand for a year. Some people make this mistake to say he can deduct 23,800. That is wrong. You are restricted to what you got. You only got 20,000, therefore you can only deduct 20,000. Do you see what I'm trying to say? You cannot go into a negative, because the limit is 23,800 for that person. So you cannot say minus 23,800 because he didn't even get 23,800. He only got 20. That is the threshold. That's the maximum amount. These are the maximum amounts that a natural person can be exempted. Guys, any questions relating to that? A lot of people make that mistake. Any questions? Do you understand what I just showed you there?
Sir, I really didn't understand.
You don't understand, Thelma?
I don't understand.
You don't understand. What I'm saying is, let's use this one where a person is younger than 65 years old. I'm saying in my test, I'll say this person got South African interest worth 50,000. What amount will be exempted? Then it's easy because you have to say 23,800. Guys, this is the maximum amount. Whether the person got 50,000 or 200,000, they will only qualify for 23,000 exemption in a year. Okay, only 23,800. So that is what I'm saying there. But let's say so that one is easy. But let's say this person only got interest for $20,000. Then I ask you again, what amount will, so obviously this will be included in gross income. Now I'm asking what amount will be exempted. Now I'm saying you cannot then say 23,800 will be exempted. What? Why can't you say that? Because this person only got 20,000. So you cannot exempt more than what he actually got. So in this case, I'm saying, then you should actually say the full 20,000 will be exempted so that it becomes zero. Guys, if you say 23,800 will be exempted, then you are actually saying we end up with a negative 3,800. And that can never be the case. It should not give rise to a loss position. It should, rather than only give rise to a zero position. What am I trying to say? You are restricted to the amount that you got. So, Thelma, I hope you got that part now. Did you get it, Telma?
Yes, I did, sir.
All right, thank you. Let's continue. So that was the interest, guys. These are the easy, nice ones that we always ask you in the test. We always ask you these things. I just give you interest, 25,000, then I know you guys will start making mistakes. Then the next one is tax-free investments. Now, guys, in Namibia, we also have this. This you find at the post office, okay? Tax-free, like the name say, tax-free. You don't pay any tax. Now, guys, here are some conditions. So tax-free investments, and you can find this in paragraph 4.5.5 in your prescribed textbook. Only designated persons may issue this tax-free investment. Like I said, for example, the post office. Guys, you will not find any of these tax-free investments at other places, but only at the post office currently in Namibia. In South Africa, same story. It should be issued to a natural person, and the person should contribute up to 33,000 per year in order for them to qualify for this tax-free investment. Then, guys, the exemption is only 500,000 per lifetime. Now, what do we mean with that? Because this is normally where students struggle. What I'm trying to tell you is, let's say I say that you have invested 100,000 in this year in a tax-free investment. Then I ask you, what is the amount that will be exempted? In that year, you can deduct the full 100,000. Why? Because you haven't exceeded your lifetime yet. And remember, you've contributed more than 33,000. So in that year, the full 100,000 will be exempted. Sorry. Let's say I actually say this year you've ignored the previous example. Let's say I'm saying this year you have actually invested 600,000 in this tax-free investment. What is the amount that will be exempted? Then you should tell me only 500,000. Why? Because once again, this 500,000 per lifetime, that is the maximum amount that a person will qualify for in their lifetime. Okay? In their lifetime. Now, guys, there's a penalty for tax or penalty tax for over contribution. So, guys, sorry, earlier when I got to this part, I made a mistake. The maximum amount per year that you contribute is 33,000. You shouldn't actually contribute more than 33,000. So if you contribute more than 33,000 per year, all the other rules that I mentioned, that is still correct. But this one was not correct when I said you should contribute a minimum of 33,000. It should be the maximum. You can contribute less, but you cannot contribute more. Now, if, let's say, for example, you contribute 34,000, you see that is 1,000 more than the maximum that you should contribute in a tax-free investment. Then we say you will pay a penalty tax of 40%. You will be penalized for that over contribution. Now, guys, this 600,000, don't get it wrong. Even though I say 33,000 per year, obviously I'm going to give you a number of years. Let's say 20 years. And I tell you for 20 years, this person contributed 33,000 per year. Obviously, you calculate all those 20 years together, and we say you will only be exempted 500,000 in a year of assessment. Then let's go to the next one. Section 10(1)(k), South African dividends. Remember, in terms of special inclusions, you must include it in gross income. South African dividends, and then we will exempt it in terms of section 10(1)(k). South African dividends received by or accrued to or in favor of any person are exempt. Now, guys, we have two types of dividends. The one is called local, and the other one is called foreign dividends. Foreign dividends. Okay. Now, certain exclusions for you There might be certain exclusions where you cannot exempt it. However, for you guys this semester, guys, just know that all local dividends will be exempted. And you can read on these exclusions in paragraph AA in your prescribed textbook. Let's have a look at foreign dividends. Section 10B2. Yeah? So guys, local dividends 10(1)K. Foreign dividends 10B2 deals with this exemption. Now guys, there's a formula and there's also a participation exemption. So there are two ways how we do this exemption. Let's look at the participation exemption. Here we say the person receiving the dividend must at least hold 10% of the total equity shares and voting rights in that company. Then the full amount will be exempted. Let me give you an example. Let's say Mr. X is a South African resident, but he holds shares in a company in Mauritius, okay? And let's say he holds shares of 11%. His shareholding is 11% in that company in Mauritius. Now the Mauritian company gives him a dividend, then we say, let's say a dividend of 100,000 Rand, the equivalent is 100,000 Rand, then we say the full 100,000 will be exempted. Why? Because Mr. X holds at least 10% of the total equity shares and voting right. Remember, I told you 11%. But what will happen if we say Mr. X only holds 9% of the equity shares in that company? That is obviously less than 10%. Then we need to go with the formula. And let's have a look at the formula. The formula is A equals B times C. A is obviously the exempt portion that you want to calculate. So non-exempt foreign dividends calculated through the following formula. A equals to B times C. A is obviously the exempt amount. B for a natural person, it is 25/45. And B for a juristic person is 8/28. Guys, these things are fixed. You should know them. I will tell you now where they got it. And C is the aggregate of the non-exempt dividends. So guys, basically, if let's say for that person who only holds 9%, then we would have said 25 divided by 45, multiply by, did I say it was 100,000 dividend? So this amount here, 25/45, that is 55,000 what? 555. So A, the exemption will be this 55,555. Now guys, where do they get this 25 and 45? That tax table that I gave you in the test, the minimum tax threshold, I don't know why they actually don't start at 18, because the minimum, the lowest tax rate, tax bracket is 18%, but for this dividend, they actually start at 25, the second bracket. The reason for that is, there's still the threshold for under 79,000 and all of that. So that is the 25. Minimum tax bracket, maximum. Just check that tax table. The highest tax rate there, percentage there is 45. Then for this one, for companies, 8 is the minimum tax rate for small business enterprises, and 28 is the highest tax rate, the corporation, the company tax rate currently in South Africa. So if you forget it in test, quickly turn over your paper to the last page, check what is the minimum tax rate over maximum for natural person. For company, minimum is 8, 28. And that is it. Guys, quickly this example, then we can end there. Mrs. Apple, a South African resident who is 68 years, has the following investments in income: South African dividends, South African interest, foreign dividends, foreign interest. Calculate Mrs. Apple's income. Obviously, we know all of that should be included in gross income. All of them, dividends, interest, foreign dividends, foreign interest. Now we need to look at what will be exempted. South African dividends, full amount. It's a local dividend. South African interest only. For the South African interest, remember how old is this lady? 68, so 34,500. There is that amount. So you cannot exempt the full 60. Foreign dividends, remember you need to calculate 25 over 45. And then foreign interest 200 should be included. Yes? There was a question?
Yeah, the question is, you said all of those for items will be included. Let's say will be included in the what? In the gross income for the resident. Even the essay, even the essay interest.
Yes. Remember, we only spoke about interest now when we got to exemptions. But remember, we can only exempt something if it was included in gross income. Guys, remember in our previous lectures, I told you, when in doubt whether an amount should be included in gross income. Guys, the only reason why an amount will not be included in gross income would be it is capital in nature. You know, look at the gross income definition and all of that. So those are the reasons why it will not be. But in most cases, all of it should be included in gross income. The issue is with this exemption. What amount of each of those will be exempted? We can end there for today. I will talk a little bit more about that to the student there. So I will talk a little bit more about that. We can end there. Our time is up. Thank you for coming. And I will now end the recording. Goodbye. We meet again on